Today we take a look at 2 different ways you can attack the stock market by either trading or investing. Now I've been getting a lot of questions from people wanting to know at what price to buy or sell a certain asset and whether they should go with options or stock. Now all of these questions can be answered by knowing if you are a trader or an investor and then following through with the fitting strategy. So let's dive right in. Why is the distinction important? By knowing if you are a trader or an investor, you can avoid making the classic mistakes on the stock market and achieve a much higher return on your capital. So here we have the chart of Google's stock price for the past 6 months. Now obviously Google is a well-known company with a lot of media attention, so when the stock gains 3.3% on January 19, this will be talked about, and when the stock shoots up a staggering 5.4% the very next day, it will be major financial news. So a lot of people will flood into the stock in these 2 days to push it up for a total of 8.7%. Some might have a legit fundamental reason for investing in Google, but others will just follow the current momentum of the stock, thinking it is on an upward trend. So you'll have people buying at 1784 and at 1880 for various reasons. Now at this point, that in itself is not a good or bad decision. What makes it a good or bad decision is what you do next. So from January 20th all the way up to January 26th, the stock is indeed on an upward trend. So everybody that bought at 1784 and at 1880 is feeling pretty awesome. Now on January 27th, you start to feel a little bit less awesome because the stock drops to $1,818, losing a total of 4.6% in a single day. If you've bought the stock at 1880, you can still sell the stock and minimize your losses for when the stock drops even more. And if you bought at 1784, you can still get out and take some profits before all of your profits are gone. So again, there are different reasons for taking the same action, which in this case is selling, and everybody that sold will feel like an idiot when only 5 trading days later, the stock is trading at $2,059. So in just 7 trading days, there are 3 likely results. Group 1, people who bought at 1784 and sold at 1818, achieving a plus 1.9%. Group 2, people who bought at 1880 and sold at 1818, achieving a minus 3.3%. And Group 3, people who bought at 1784 and are still holding or selling at $2,059, achieving a wonderful plus 15% gain. This all highlights why it's important to know whether you are a trader or an investor, because when the market forces you to choose between selling and holding, you could lose your money or leave a lot of money on the table by not following through with your strategy. Now, if you're not an investor, you do not buy the dip. This is something you hear a lot online, and I will explain in a moment why this is important. If you are an investor, you can buy the dip as long as it fits in your strategy. Traders and investors can both make a lot of money, it's just done in a different way, and mixing the two up will cost you your profits and might even prevent you from being profitable at all. So what is trading? Well, in short, trading is the art of profiting from market volatility. And what this means is that you do not care about what you're buying. You sometimes don't even need to understand what the company does, how they do it, or if they're any good at it. You just need to understand what the market forces are and how different variables impact the price of an asset. A perfect example of this is when I shorted Wirecard. Before we continue, please like and subscribe to the channel for more finance and banking information. I had not even heard of the company before the rumors of fraud started surfacing, but as you can see on this chart right here, you don't need much analysis to make money in this type of situation. Now I must say, I did not expect the company to go bankrupt and the stock to drop all the way to zero, so I got out too early, but it was still a nice profit for just 5 minutes of reading. So this example illustrates one of the key differences between trading and investing. When you invest, you expect your investment to grow with time, and when you trade, you can also profit from the underlying asset going down in value. This brings us to the most important aspect of trading, and that is, what is the time horizon? Now a good time horizon for a trader is 1 to 3 months. However, you can of course deviate from this in specific cases. So in the Wirecard case, it was a perfect example of something that was happening right now, and you had solid information indicating a major volatility. The 1 to 3 month time horizon does not mean buy something, keep it for 3 months, and then sell at a cozy profit. It's just an indication of how wide you should cast your net. Since you are looking for volatility hotspots, you want to buy or short right before the run or the dip happens and collect profits before the turnaround point comes along. So if your time horizon is too long, you'll never collect real profits, so you don't even know if the stock is going up in the long run or if it might stay stable for years. So we have established that too long is not good for trading. Now what about too short? Well, if you're dealing with a very strong catalyst, a few days might be justified. But if you're looking at a stock chart with a 5-minute time window, you are making it real difficult for yourself. Another reason why a too short time horizon, and especially a 5 or 50-minute candlestick chart, is not advised is because it's not your job as a trader to watch a chart line go up or down. You need to be formulating new trading strategies and expand your portfolio. So you don't have time to just watch one chart, you need 10 to 20 trades going on at all times, and this will help you to manage your risk. So while you have these 20 trades going on, you constantly have to watch the market to see what could hurt any of your trades and ask yourself, do you need to cut your losses or take your profits, all while looking for new opportunities to take advantage of. especially the cutting your losses part is an important one, and this is another key difference from investing. Earlier we talked about not buying the dip when you are trading, and this ties right into that. When you are trading, you are predicting a certain move in the market, and since you are not a genie, you are going to be wrong some of the time. Now sometimes the market makes no sense when the company presents great quarterly results and the share price takes a dive. However, that does not matter to a trader. You have to reassess the situation and decide how to handle it. Like I showed in the Neo Is the Dip Over video, linked up here, if you chase the dip, you could be buying the dip at $59, $54, $49, and even $45, and this throws your portfolio completely out of whack. You are now over leveraged in just one stock and you have no guarantee that it's going to recover quickly. Next to this, you've kept the stock that went from $59 all the way down to $45, achieving a minus 23.7% result, which is obviously not ideal. And this brings us to a third key difference between trading and investing, which is the type of risk management. When you invest, you are in it for the long run, so whatever the stock does should have no influence on your decisions. You are more interested in the inner workings of the business. With trading, this is exactly the other way around. You care very much about the fluctuations in the stock price, but at the same time, you want to stay within a certain variance. This means you don't want all your trades to go all over the place. One goes up 16%, another goes down 14%, a third one goes down 29%, and then a fourth one goes up 35%. You might feel like there's not much wrong with this, since the bad trades are canceling out the good ones, but this is way too volatile. You are technically allowing your portfolio to lose 29% of its value in the hopes of making 35% on the high end. I would much rather risk losing 10% to make 18%, since this gives me much more stable returns year over year. When you start putting together a good trading foundation, you start to see why pro traders get no sleep and are so stressed. It is hard to trade properly and requires your full commitment. Compare trading to working out and getting a six-pack. All the required tools and information are out there. There is no secret way to do it. But still, many people struggle to get that six-pack because it's hard and requires you to follow through. So what is investing? Now, investing is all about the company instead of the share price. You analyze the financial results, look at the products and services that the company provides, and evaluate the overall market that the company operates in. Based on these three elements, you make a prediction about the performance of the company for the next 1 to 2 years. So as you can see, your time horizon is much longer than that of a trader. The reason for this is that with investing, you basically invest in business processes and they take time to implement. For instance, right now Tesla is building a new mega factory in Germany. While this is happening, the company is spending a lot of money on construction, hiring and training of the employees, and later securing resources for building the cars. This all means huge amounts of outward cash flow without any revenue coming in. This will naturally hurt the profitability of the company and can prevent the share price from rising. However, as soon as the factory is fully operational, Tesla will have a major expansion of its production output and thus greatly increase its revenue. It will also be able to use scaling effects to lower the per unit cost for the cars, so the company will see a huge financial upswing. This is where you finally start seeing some serious gain from your investment, so buying Tesla shares today is basically buying the revenue and income streams 1 to 2 years from now when the factory is online. Now, a trader doesn't want to wait this long and wants to buy closer to the spike, so a trader might be waiting for the company updates to determine a period of volatility leading up to the completion of the factory. This means the trader has money free to trade in other opportunities and can trade in Tesla later on. However, in the meantime, the stock can still slowly rise, lowering the trader's return compared to that of the investor. Both the trader and investor can make money on this stock for the same reasons. The only difference is that the trader will realize the gains in a much shorter time frame, but he or she will have a much harder job finding the ideal entry point. This will increase the risk of the trader losing money on the deal. The investor has very little risk of losing money, since he or she simply has to wait for the factory to be completed. For a growth stock like Tesla, it's very unlikely that after 1 to 2 years the share price has not increased. This will only happen if there is a major negative move in the market or if the company makes a huge error. But this is simply part of the general investment risk that you will always have compared to savings or bonds. So investing comes down to buying future revenue or income streams, and these could be generated in various ways. The skill level of the management team plays an important role in this. The company could, for instance, add more products or services, grow the business by taking over other companies, or expand into new markets. A company could also increase the operating margin on existing products and thus become more profitable, or increase dividend payments to shareholders. As you can see here, there are many different ways in which the management of a company can improve the business and thus add value for shareholders. This makes evaluating the management a crucial part of the investment decision. A great example of investing in management is with Apple and Steve Jobs, where people just trusted his vision and ability to steer the company in the right direction. Under his leadership, Apple realized immense growth and the shareholders profited greatly along the way. A more recent example of not so successful leadership is with Intel boss Bob Swan. Check out the video linked up here for more details on how this will boost the share price. In this case, you have an excellent finance guy that runs the company pretty okay, but lacks the technical know-how and vision to compete with Nvidia and others, making the future unsure for shareholders. It was an excellent move to replace him because this is basically what happened with Nokia when Apple entered the phone market. Here you have a huge Fortune 500 company that lacks the visionary leadership to adapt to a disruptive force in the market. And no matter how big you are, in time this will cost you dearly. Next to looking at the management, you can also just focus on the financial results in the quarterly report. This will show you if the revenue is on an upward trajectory and if the company is operating at a profit with increases in revenue. All this financial data is important because when the share price drops, it will tell you if the company is now undervalued and if it's time to buy more shares at a discount, or it can show you that the company is in financial trouble and you need to reevaluate your investment. Which is better, trading or investing? Now that we have a good sense of what trading and investing is, the natural question will be which is better, or for some, which will make me the most money? The simple answer to this is the one that best fits your personal style, because it doesn't matter which of these makes the most money if you can't execute the strategy properly. Trading requires much more attention and is more difficult to consistently perform well at, whereas investing requires more patience and a deeper understanding of the business and the market environment. So let's look at some of the benefits and drawbacks of these two. The first of these is time management. Now, proper trading means having a trading strategy with multiple positions going at the same time, and this leaves you with exposed capital for each trading day. So you will be required to closely monitor the development of your positions and develop new trading strategies as the market changes. As you can see, this takes up a lot of time. Investing strategies, on the other hand, take up far less time after you've bought an asset. You only spend time researching the company or the asset, which can be done in the weekend or at night, then spend a few minutes buying the asset you want, after which you won't have to worry about them for at least a couple of months. You can check the news headlines to see if anything major is happening, but mostly you'll be watching the press releases of the company itself. When it comes to difficulty, trading is by far more difficult than investing. With investing, you just have to know if a stock will go up or down in the next 2 years. Even if you only make 4 to 6% return, it's still more than you would get in a savings account. With trading, you are more at risk of making a bad call and having the market move against you. You then have to quickly adapt, which can increase the loss if you don't act fast enough. When you're trading, you also have access to more advanced financial instruments, such as futures, options, and swaps, and these instruments can be more difficult to understand and expose you to even more risk. Like I stated earlier, your capital is more at risk when trading, and this is why you need to monitor your trades more carefully than your investments. Depending on which type of financial instruments you use, you could increase this risk even more, especially if you add leverage to that. The main way to reduce this risk is to open multiple trades, just like you would with investments, so this means building a portfolio rather than just trade one asset and watching that chart all day. Now, even though investments can go down in value as well, you can further reduce this risk by investing in companies that also pay a dividend. So even if the stock drops 16% in a couple of months, you still get the dividend payments, and if the stock is at the same level at the end of the year, you could be looking at a 3 to 7% dividend yield. So the main takeaway here is that sudden changes in the share price are less of a concern for an investor. However, for a trader, they are a great opportunity to make money, but can also be a huge risk when the change moves against the trade. This move can force a trader to close his or her position or trigger a margin call, forcing the trader to put more money at risk. With investing, it's unlikely that a move in the share price will force you to close your position. This will most likely come from changes in the market or in the business model of the company. When it comes to profits, both trading and investing have unlimited gains. You can't say that one makes more than the other. However, with trading, you do get to realize those gains much quicker, which you can then reinvest. This active approach would allow you to achieve higher returns during the year versus a passive investment approach. However, a passive investor could still choose the right stocks and achieve a very large gain during the year, which would then lead to both of them ending up with similar results. In this case, the only difference is the immediate gratification experienced by the trader versus testing the patience of the investor. This is why it's important to pick the one that suits you best. When we compare hedge funds to mutual funds, which basically puts traders versus investors, we see that the gains are all over the place. In a single year, some hedge funds have managed to achieve amazing gains in a 90 to 120% region, while some fund managers have also achieved gains at that level. ARK Invest even managed to do 180% last year, and Ron Barron did about 150%. So what this all comes down to is that you can basically make the same amount of money with either trading or investing, and the important takeaway is that you make sure that you follow the correct strategy for each one. This was an overview of trading versus investing. Please like and subscribe to the channel for more finance and banking information.